Did you know that by 2026, some U.S. states may see home prices drop more than 10%, erasing years of gains? After a decade of soaring values driven by low interest rates, migration, and tight inventory, the housing market is entering a major shift. For homeowners, renters, buyers, or investors, understanding these changes could protect your finances, as certain states, from Florida's coasts to Michigan's industrial cities, face steep declines. In this breakdown, we'll reveal the top 10 states most at risk of price drops by 2026 and the forces behind them, including local economies, migration shifts, rising insurance costs, and supply imbalances. As 2025 unfolds, higher mortgage rates, cooling demand, and growing inventory signal a nationwide slowdown, especially in overbuilt markets like Texas and parts of the Midwest. Key pressures include mismatched supply and demand, economic uncertainty, fading pandemic migration trends, and worsening affordability. Insurance costs in disaster-prone states like Florida and California are also pushing prices downward. In this video, we'll explore the data, real examples, and market dynamics shaping these vulnerable states so you can make smarter buying, selling, or investing decisions in the changing U.S. housing landscape. Number 10. Charleston. South Carolina Charleston has long been a magnet for homebuyers drawn to its rich history, scenic coastlines, and vibrant culture. However, the housing market here is facing challenges as the influx of new residents slows and housing inventory begins to rise. After several years of rapid price growth, the market is starting to cool. This slowdown is particularly noticeable in the luxury and second home segments, which have seen fewer eager buyers in recent months. Factors such as rising mortgage rates have also squeezed affordability, pushing potential buyers to seek alternatives or delay purchasing. The city is now projected to see a negative 5% decline in home values from mid-2025 to mid-2026. The local economy, heavily tethered to tourism and hospitality, remains vulnerable to broader economic cycles and rising inflation. Any downturn in these sectors tends to ripple through the housing market, reducing demand for both primary residences and vacation homes. As a result, sellers may feel compelled to lower asking prices, contributing to the forecasted dip in home values. Despite these challenges, this softening presents opportunities for buyers. Those who were previously priced out can now enter the market with more reasonable expectations. However, the anticipated decline also serves as a cautionary signal for markets that rely heavily on lifestyle appeal and seasonal economies without sufficient economic diversity to buffer shocks. Number 9. San Francisco, California. San Francisco's housing market is synonymous with volatility, shaped largely by the tech sector's boom and bust rhythms and an exceptionally high cost of living. The rise of remote work since the pandemic has eased pressure somewhat, as many tech employees relocate to more affordable cities or work from home, reducing local demand. Slower hiring trends in the tech industry further compound this effect, while supply constraints such as strict zoning laws and high costs limit new housing development. Demand softening has nonetheless led to an increase in home inventory and lengthier selling times. The city is currently expected to experience around a negative 5% decline in home values, mostly through 2026. Additionally, residents contend with high property taxes and ongoing regulatory challenges that add layers of complexity for buyers and sellers alike. Conversely, savvy long-term investors may view the current dip as a buying opportunity before the tech industry potentially reignites future demand. This scenario illustrates how San Francisco's housing market embodies the interplay between economic restructuring and demographic shifts, resulting in cycles of sharp price adjustments, particularly in premium, supply-limited urban environments. Number 8. Austin, Texas. Austin has been among the fastest-growing housing markets nationwide over recent years. Known for its thriving tech scene and vibrant cultural environment. However, after sustained rapid growth, the market is showing signs of correction. Rising mortgage rates, increasing inventory, and a slowdown in migration have combined to cool what was previously a red-hot market. Affordability challenges remain a significant barrier, especially for young families and first-time homebuyers, who find it increasingly difficult to keep pace with home prices. Forecasts now point to a -5.1% price decline from mid-2025 to mid-2026. While the local economy is robust, anchored by technology and educational institutions, the housing sector must now adjust to more balanced conditions. Austin's experience underscores the twisting dynamics of growth markets, where rapid appreciation can quickly give way to correction. Both buyers and sellers must navigate a market that is becoming less predictable and far more balanced compared to recent years. Number 7. Beaumont, Texas. Beaumont, a smaller Texas city with strong ties to energy and chemical industries, faces economic headwinds from cyclical downturns in these sectors. Combined with stagnant population growth, these challenges have created an oversupply of homes relative to demand, putting downward pressure on prices. The market is currently projected to see a negative 5.8% decline through August 2026. As property values decline and rental demand softens, investors face diminished cash flows and greater market risks. On the flip side, potential buyers may find themselves with greater leverage during negotiations, though concerns about looming instability temper optimism. Beaumont's housing market serves as a microcosm of how dependence on specific industries can magnify housing risks, especially when broader economic forces turn unfavorable. Number 6. Shreveport, Louisiana. Shreveport's housing market reflects a shrinking population combined with limited economic diversification. The local labor market provides few new jobs that would promote household formation and home purchases, while rising inventory, particularly from foreclosures and distressed properties, adds further downward price pressure. Home values here are forecasted to fall negative 6.6% from mid-2025 to mid-2026. Policy efforts aimed at stimulating economic growth and housing market stabilization have had limited success, leaving the market in a state of flux. Sellers are seeing slower equity growth, which can inhibit mobility, while first-time buyers approach the market cautiously given the uncertain economic outlook. Shreveport underscores the sustained challenges experienced by smaller metros grappling with demographic decline and economic stagnation, highlighting the extended periods of housing market softness that can result. Number 5. Lafayette, Louisiana. Lafayette's housing market stands out as one of the most vulnerable in the U.S., hit hard by declines in energy sector employment and sustained out-migration. Population loss has led to an increasing supply of available homes relative to the number of buyers, which dampens price growth and often forces sellers to accept less favorable terms. The market is expected to decline negative 7.0% from mid-2025 to mid-2026. Job losses and weak consumer sentiment add to pressure as many homeowners opt to sell for lower prices amid economic uncertainty. Despite this, some buyers remain cautiously optimistic, attracted by the increasing affordability, though they remain wary due to the persistent economic headwinds. Lafayette's experience highlights the outsized risks faced by markets heavily dependent on commodity-driven industries, where economic downturns translate directly into housing market instability. Number 4. New Orleans, Louisiana. New Orleans is wrestling with a mix of factors that are suppressing its housing market. The city's economy, heavily dependent on tourism, continues to suffer volatility from changing travel patterns post-pandemic. Coupled with long-term population declines and increasing housing inventory, demand for homes is waning. The market is forecasted to drop -7.2% through August 2026. Rising numbers of distressed property listings contribute to the downward pressure on prices. For homeowners who depend on the equity in their homes to finance moves or career changes, these conditions complicate financial planning. Meanwhile, buyers and investors are keenly watching for price declines that could signal buying opportunities. This market reveals the vulnerabilities inherent to tourism-dependent economies, which often face amplified housing market impacts during periods of economic contraction and uncertainty. Number 3. Alexandria, Louisiana. Alexandria, a smaller metro area with a limited industrial base, is confronting the dual challenges of rising housing inventory and population decline. The local economy has yet to generate sufficient new employment opportunities to stimulate demand for housing, resulting in substantial downward pressure on prices. Forecasts now indicate a -8.0% decline from mid-2025 to mid-2026. Sellers in Alexandria face intense competition for buyers, leading to longer selling times and price concessions. Prospective buyers may benefit from these conditions by finding more accessible price points, though the broader economic uncertainties temper enthusiasm. Alexandria exemplifies how smaller cities with less economic diversity are particularly susceptible to housing market weakness in the face of adverse demographic and economic trends. Number 2. Lake Charles, Louisiana. Lake Charles's housing market feels the impact of economic downturns in its core energy and petrochemical industries, which have led to significant job losses and population decline. The resulting surge in home inventory relative to buyer demand has pushed prices sharply lower. Projections now show a -8.5% decline from mid-2025 to mid-2026 for families and retirees hoping to sell their homes. The prospect of declining home values presents a financial challenge. Conversely, investor interest remains as some look beyond the immediate downturn toward potential long-term recovery. Lake Charles illustrates the risks markets face when tied closely to volatile industries, where macroeconomic forces swiftly influence housing fundamentals. Number 1. Louisiana State overall. The state of Louisiana as a whole leads the nation in forecasted home price declines. Persistent structural challenges, including steady population loss, heavy reliance on the oil and gas sectors, and aging infrastructure, weigh heavily on housing demand. Although state policies have aimed to mitigate these issues, elevated housing inventory levels and lingering affordability problems remain major hurdles. Statewide trends now point to broad declines, with areas like Houma forecasted at -9.6% from mid-2025 to mid-2026, or through August 2026, representing some of the steepest drops in the country. For homeowners, this projected decline translates into significant losses in home equity and difficulties in refinancing or relocating. Buyers attempting to capitalize on lower prices must carefully consider the economic risks tied to the region's challenges. Louisiana provides a poignant example of how deep-rooted macroeconomic and demographic factors can converge to disrupt regional housing markets, creating widespread and sustained price declines. Overall, these markets share common pressures: rising inventory, outmigration, economic instability, and affordability challenges. Areas tied to energy, tourism, and tech face the biggest corrections as local job markets shift and demand cools. The result is a patchwork of regional declines rather than a nationwide crash, driven mostly by structural weaknesses and changing migration patterns. For buyers, falling home prices create rare opportunities. Markets that were previously too expensive now offer more negotiable prices, better terms, and increased inventory. However, purchasing in a declining market requires caution, especially in areas with weak job growth, population loss, or high insurance risk. Buyers who plan long-term may still benefit despite short-term volatility. For homeowners, these declines can mean slower sales, reduced equity, and tougher refinancing options. Sellers may need to price more competitively, invest in repairs, or offer incentives to attract buyers. In many cases, holding property longer or renting instead of selling may be the better financial decision until markets stabilize. The broader U.S. housing market remains mixed. High-cost coastal cities are correcting. Sunbelt markets are cooling after rapid pandemic-era growth, and insurance challenges are reshaping coastal affordability. Mortgage rates are expected to gradually ease, but economic uncertainty and regional disparities will continue to define the market into 2026. Key risks include population decline, job market instability, energy sector volatility, tourism dependency, and rising insurance premiums, especially in hurricane-prone states. Oversupply of new construction in some regions and aging infrastructure in others add further downward pressure on prices. Areas with diversified economies, strong in-migration, and emerging industries may stabilize faster. Tech hubs could rebound if hiring picks up again, and energy-dependent markets may recover with commodity cycles. Regions investing in infrastructure and job creation tend to recover ahead of those relying on one or two major industries. Investors should focus on long-term fundamentals rather than short-term value swings. Cash flow positive properties in stable neighborhoods remain strong choices. Markets with temporary declines but strong economic potential may offer good entry points, while areas with long-term population loss or industry dependence carry higher risk. In the end, housing markets rise and fall with the people who live in them. Each city tells a story shaped by its economy, culture, and future potential. Understanding these shifts helps buyers, homeowners, and investors make smarter choices as the market moves into a new cycle of adjustment and opportunity. If you found this breakdown useful, be sure to like the video, subscribe to the channel, and share it with others who follow the housing market. Your support helps us create more in-depth research, analysis, and long-form content just like this. Thanks for watching, and we'll see you in the next one.